Right now, CoStar has their projections for Q4 at about half of what Q3 was. Now, I don't know. That's their current numbers, and we're about like a little more than halfway through.
Sometimes I wonder on CoStar, sometimes their algorithms on the forecasting, like they follow that trend, and which like sometimes that is fine, but like they take out the like, oh, it's the end of the year, so you actually see a little blip, seasonally. I don't know.
So I
want to talk again, because on this topic of, time to buy or not buy, looking at, again, storm clouds, kind of, forming over, or they've been hanging out here. We've got loan maturities. We've got all this debt that's out there. Federal government, multifamily business, everybody. But then, RealPage, they have a compelling piece by Jay Parsons. The census is likely overstating multifamily starts in 2023, which means that we may not see, vacancies levels as bad as we might have thought, and could potentially be seeing kind of a bottoming out of the slowdown, not deterioration, but the slowdown in multifamily fundamentals. Matt, you did a really nice write-up. What's your take on the Jay Parsons
we've been
piece?
tracking the reduction in multifamily starts on the Gray Report, alongside like a bunch of, a lot of these multifamily experts and reports have, we've just described why. Interest rates are high. There's not a lot of projects going on. But this analysis here from the much admired by Gray Report, Jay Parsons, I think it really cranks up this possibility even more that starts are lower than we have and others have anticipated in 2023. And we already thought they'd be lower. They're even worse, lower. High, and the reason why is not a mystery to anyone. It is higher interest rates. It's made so many of the multifamily development projects that once made financial sense, they're not profitable anymore. It's not like all of them aren't profitable, but maybe out of X, Y, and Z, maybe only Y or Z.
No, it's hard. Yeah, talking to most developers, it's hard to pencil right now.
Yeah,
with leverage financing. And rent's not as high as they thought they might be.
Yeah, that's a good point. It's like their projections, and getting back to like what I said about the reactive nature of these developers, like they're making such a big bet, and they're not gonna if they're not gonna ignore rent growth or ignore supply trends or whatever. They're trying to get ahead of it as much as they can. So again, this is not a runaway train, and this article proves it out in that the census says that apartment builders have started 12% less projects than last year, but Jay Parsons argues that it's likely closer to 40% less. And he writes that it appears the census underestimated multifamily starts in 2022 and overstated them in 23. It is an issue of higher interest rates, but also loan to cost ratios dropping from 65 to around 50 to 55%. So they've got to get more money. And so this tightening standards is bringing about not like even canceling the projects, but just delays. And the problems with delays, Jay Parsons says, is like they can be indefinite. You can delay it forever, and so that it makes it difficult. But it also is. It's difficult for the developer side, but it's also an example of like, they're reacting. These projects, once they get started, sometimes they don't get finished. And we have talked about like the attrition rate from going from permits to actual starts to completions. There's a lot of hurdles that have to happen, and things could not get finished in that time.
And like not finishing doesn't necessarily doesn't typically materialize in like the building's halfway built. It's usually like the land's ready to go. Maybe the permitting is in place, but they're not pulling the trigger on doing the actually starting moving dirt.
And I thought it was really interesting. It was the cause of these delays. It said something like 90% of some of these delays are in some way connected to financing, either financing or getting funding or just getting the money.
Hard to raise capital. The leverage isn't there, and the leverage isn't there. The returns aren't there, and you can't raise the capital, and it's a vicious cycle.
Because another way for labor and commodity shortage is just higher labor prices, higher commodity prices, so you can pay for things to go quicker. But if you don't have that money, then there's going to be delays.
Exactly.
But widening the lens a little bit, Jay Parsons says that construction volumes, and I mentioned this, and I still think this is a really powerful statement here. He says construction volumes from 2021 to 2022 could very likely go down as a generational high akin to the 1970s, resulting from a perfect storm of ultra-high demand and rent growth, plus an environment of cheap debt and low cap rates that incentivized ground-up development. It really was this, call it perfect storm or just like the an investment miracle. Did he call it? Because it wasn't a storm necessarily. It was just this ideal situation. It was favorable winds, let's say.
There we go.
But it's not to be understated how much building there was, and comparing it to the 1970s. If you take any look at these long-term trends, like 1970s was a blowout year for apartment. That was like when they were building all the places for the boomers to live in. So this is notable and very likely something that we won't see ever again in our lifetimes.
This type of construction. Yeah.
So, we're in the wake of so many of these different generational high points and low points in the apartment market, whether it's rent growth, financing, cap rate spreads, or apartment supply.
It underlines, so what you're saying is like we're basically experiencing a supply shock. Maybe not as bad as what was first anticipated in forecasts, but as strong of a supply shock really the market has ever seen, and likely will ever see. And absorption is still like decently strong now. Supply is outpacing absorption. Vacancies are higher, but it's not it's not like everything is horrible. A lot of things are maintaining. Rent levels again increased so much over the last couple of years. Again, back to your point, it could be so much worse. And the fact that it's not that much worse underlines the strength, and you remove some of the headwinds. You're just going to be off to the, just going to be smooth sailing.
So it's a testament to
relative smooth sailing. I don't qualify that. Never smooth sailing in this business.
But it is a testament to the stability of the apartment market. Full stop. And any discussion, and we'll get to a little bit of the. We'll quickly cover the apartment list rent growth report, but you have to put that into context that we're seeing some of these kind of historical movements right now. Yeah.
Well, let's just jump right over to that apartment list report, Matt. Looks like United States, the median rent 2017 to present, a couple oscillations moving sort of to the downside. It'll be interesting. Typically in the fourth quarter, we see the most declines just seasonally. In your opinion, Matt, this winter, specifically December, the month that we are going to begin in 2 days. So as folks are watching this video, listening to this podcast, are we entering the bottom of rent declines?
Yeah.
Yes.
I think so. And it's more instructive here. So yes, the top line number is about a negative 1% year over year, whether you're talking about nationwide median, which is below 0.9 or whatever they said as year over year rent growth is at negative 1.1%. But
and 1.1 is like, again, back in the pandemic back in the great financial crisis, I think it was closer to negative 3. Negative 1 when we had 30% growth over the last total over the last couple of years is not that. Again, come on, that's not a whole lot of it. That's a mean reversion.
Look at this chart though. Exactly. Like if you draw a straight line from you're still not really making. If you draw a straight line from 2017, to 2019
chart tools
and extend that into 2023, you're still not where we are. It jumped up so much in 2020 that you would expect a slightly stronger adjustment, a slightly stronger drop, I guess, but because we're in the wake of this super high rent growth. But to kind of double down on my point here, it does look like we are approaching a little bit more of stability. If you look at the month over month chart that they have, a little bit below this line graph, there is a series of bar graphs that show, a bar graph that shows how rents have changed every single month. And in 2022, the monthly dip in rent growth in November was more than 1%, and it's slightly less this time. It does seem like, as we said before, that this winter is going to have the same rent growth pattern as 2022. but weaker on the downside than 2022. So yes, we will see a dip. It won't be as dramatic or sad for apartment investors as 2022 was, and I think it is a sign of greater stability and an adjustment to, I think, steadily declining numbers of new supply in apartments. But it's going to be a long time coming. But this is a clear sign, like this, things aren't getting worse, but we just have to we've got to stay strong.
Yeah.